Everyone says renting is burning money. It's the financial equivalent of lighting cash on fire, apparently. Meanwhile, buying a home is treated like some kind of cheat code to adulthood, wealth, and respectability. Your parents say it, your coworkers say it, random strangers say it, and after hearing it 1,000 times, most people stop questioning it. But here's the uncomfortable truth no one likes to admit out loud. In most real situations, buying a home doesn't make you richer, it makes you feel richer while quietly draining your future upside. And when you run the full math instead of the marketing slogan, renting wins far more often than anyone wants to believe. Let's start with how the myth begins. Buying feels productive. You're investing. You're building equity. You're doing something grown up. Renting feels passive, temporary, like you're stuck in the waiting room of life. That emotional framing is powerful, and it's exactly why the numbers get ignored. Because once emotions enter the room, math tends to leave. Picture two people, same age, same income, same city. One buys a home, the other rents a similar place. Everyone congratulates the buyer. No one throws a party for the renter. But fast forward 20 or 30 years, and the outcome is often reversed, not because the renter was smarter, but because the renter accidentally avoided a financial trap disguised as a milestone. The first trap is the down payment. This is where the damage quietly begins. A large chunk of cash gets locked into a single illiquid asset. People say it's not gone, it's equity. That's technically true, but practically misleading. That money is now frozen. It can't compound freely, it can't rebalance, it can't chase higher returns. It just sits there, tied to one local housing market, hoping nothing goes wrong. If that same money were invested broadly instead, history shows it would likely double every decade. That's not optimism, that's math. Over 30 years, that original down payment can grow into several times the value of the house it was meant to buy. Home equity grows slowly. Compounding capital grows aggressively. This difference alone explains why renting often wins, even before we look at anything else. Then comes the mortgage, which people love to describe as paying yourself. That phrase should immediately raise suspicion, because for the first half of a typical mortgage, you're not paying yourself much at all. You're paying the bank a lot. Interest dominates the early years, and by the time principal finally starts to matter, you've already handed over an eye-watering amount in interest payments. And interest is just the beginning. Ownership has a long list of costs that never get mentioned in the rent versus buy argument. Property taxes rise, insurance rises, maintenance never stops. Something is always breaking, aging, leaking, or failing. Roofs don't last forever, neither do appliances, driveways, or plumbing. Even well-maintained homes demand a steady stream of cash just to avoid falling apart. Rent feels expensive because it shows up as one clean number. Ownership feels cheaper because the costs are fragmented, delayed, and emotionally disguised. But when you add them all together over decades, the total is shocking. Many homeowners end up paying close to the original purchase price again just to keep the house functional. Then there's appreciation, the crown jewel of the home ownership argument. Homes go up in value, right? Yes, but not nearly as fast as people assume. After inflation, residential real estate has historically creeped upward at a modest pace. That's before costs. Stocks, on the other hand, have grown much faster on average, and they do it without calling you at 2 a.m. because a pipe burst. This is where renting flips the script. Renters aren't responsible for repairs. They aren't exposed to local market crashes in the same way. They aren't locked into one asset. And most importantly, they can invest the difference. The money not spent on maintenance, taxes, and interest can be deployed into assets that compound harder and faster over time. That difference doesn't need to be dramatic to matter. Even a few $100s a month invested consistently can snowball into a massive gap over decades. Compounding doesn't care how exciting the investment feels. It only cares that you keep feeding it. Flexibility is another hidden advantage no spreadsheet fully captures. Owners are sticky. Selling is slow, expensive, and emotionally draining.
That friction keeps people in jobs they've outgrown and cities that no longer make sense. Renters can move for better pay, better lifestyles, or better costs of living with far less resistance. That mobility often translates into higher lifetime income, which quietly dwarfs housing gains. So where does the 70% come from? It comes from running scenario after scenario, different interest rates, different rent-to-price ratios, different maintenance assumptions, different investment returns. In most realistic cases, especially for people who move every 5 to 7 years, renting and investing the difference leads to higher net worth with lower risk. Buying only wins under specific conditions: long time horizons, controlled costs, strong appreciation, and minimal disruption. That's not most people's reality. This doesn't mean buying a home is a mistake. It means it's a lifestyle choice, not a guaranteed financial win. Stability has value, control has value, emotional security has value, but those are personal benefits, not universal math. The real mistake is believing there's only one right answer. The real danger is making a massive financial decision based on social pressure and outdated advice instead of full numbers. Renting isn't throwing money away, it's paying for flexibility, reduced risk, and the ability to let your capital work harder elsewhere. So if you rent, you're not behind. You might actually be ahead, just in a way that doesn't come with a ribbon-cutting ceremony. And if you own, understanding the trade-offs doesn't mean regret, it means awareness. Because wealth isn't built by following tradition, it's built by understanding leverage, compounding, and opportunity cost, even when the conclusion feels uncomfortable. That's the hidden math no one likes to talk about, not because it's wrong, but because it challenges one of the most deeply held financial myths of modern adulthood. If this challenged what you've been told about money, subscribe. We break the myths so you can follow the math.